3 months back, a woman named Rebecca stepped into a mortgage lender's office carrying a credit score of 621. The loan officer gave her the news she'd been expecting. She could get approved for a mortgage, but the interest rate was going to hurt, nearly 7% on a 30-year loan. For a $350,000 house, that rate meant she'd be paying more than $180,000 extra in interest compared to somebody with excellent credit. Rebecca asked if she could get 90 days to bring her score up before locking in that rate. The loan officer gave a polite smile and said, "Sure," but told her not to get her hopes up too high. Credit scores don't move fast. A couple of months wouldn't make much difference. 93 days later, Rebecca came back. Her credit score was now 761. The loan officer actually wondered if she'd given them the wrong Social Security number. She hadn't. Rebecca had just figured out something built right into the credit scoring system that most regular people never find out about. Something that banks and credit card companies know perfectly well, but have absolutely no reason to tell you about. That 140-point increase saved Rebecca more than $215,000 in total interest over the life of her mortgage. Same house, same job, same person, just different information. What Rebecca figured out wasn't some trick or scam. It wasn't arguing about correct information or finding technical errors. It was a real feature of how credit scores get calculated, sitting right there in the open. But the financial industry makes money by keeping it hidden. Today, I'm going to walk you through exactly what Rebecca learned. By the time this video ends, you'll understand why everything you've heard about building credit slowly over many years is technically correct, but practically designed to mislead you. There's a quicker route that the system actually allows, but nobody wants to advertise it. Let me start by breaking down why the usual advice about credit scores keeps people stuck way longer than they need to be. The normal guidance tells you to pay your bills when they're due, keep your balances small, don't open too many new accounts, and wait. Wait for years. Wait for decades. Let your credit history get old like a fine bottle of wine. Eventually, your score will rise into the excellent range. This advice isn't false. It's just missing important parts in a way that helps lenders make a lot more money. Every single month you spend in the fair or good credit categories instead of excellent is costing you real money. You're paying higher interest rates on credit cards, getting worse deals on car loans, facing steeper mortgage rates, paying more for insurance in a lot of states, and putting down bigger security deposits on rental apartments. The credit score tax hits hardest on the people who have the least money to spare, and the slow traditional path keeps them paying that tax for many more years than necessary. Banks make profit from this long timeline. Someone with a 680 score, who should have a 780 score, is a customer who makes them more money. They're paying higher rates. They're creating more interest income. The bank doesn't benefit from helping them escape that category quickly. And the technique Rebecca discovered involves something called authorized user tradelines. Understanding how this works means understanding how credit scores actually get calculated. Your credit score is basically a mathematical prediction of how likely you are to fail to pay back a debt within the next 24 months. The formula looks at your credit history and matches your patterns against millions of other people. It finds factors that relate to not paying and factors that relate to reliable payment. The biggest single factor is payment history. Have you been paying your bills when they're due? This makes up about 35% of your score. The second biggest factor is credit utilization. How much of your available credit are you using right now? This makes up about 30%. Here's where things get interesting. The third biggest factor is how long your credit history is. This includes how old your oldest account is, how old your newest account is, and the average age of all your accounts. This factor makes up about 15% of your score. Most people think that length of credit history is just a matter of time passing. You got your first card when you were 18. You're 30 now, so you've got 12 years of history. Nothing you can do about it. Just keep waiting. But that assumption is incorrect. And the mistake is exactly where this technique exists. When you become an authorized user on somebody else's credit card account, that account's complete history shows up on your credit report. The account's age, payment history, credit limit, and how much is being used all get transferred to your file as if you'd been part of that account since the very beginning. Read that one more time because what this means is huge. If your father has a credit card he got 22 years ago with perfect payment history and low usage, and he adds you as an authorized user today, that 22-year-old account shows up on your credit report right away. Your average account age could jump from 2 years to 12 years in a single night. Your total available credit could double or even triple. Your longest account history could stretch back by decades. This is exactly what Rebecca did. Her father had 3 credit cards with a total age of more than 40 years, perfect payment history, and usage under 5%. Rebecca became an authorized user on all 3. Within 2 billing cycles, not those accounts showed up on her credit reports. Her thin credit files suddenly looked strong. Her short history suddenly looked established. Her score jumped 140 points. The authorized user approach isn't a secret to people working in the credit industry. Mortgage brokers are aware of it. Credit repair companies are aware of it. Banks definitely are aware of it. But it's almost never advertised to regular consumers because there's no money in shortening the time people spend paying high interest rates. Let me give you another example that shows how this works in different situations. Derek was 25 years old with a credit score of 589. He'd made some mistakes in college, missed a couple of payments, and maxed out a store card during a tough semester. He was trying to finance a used car, and every dealer was quoting him interest rates above 14%. His grandmother had credit cards going back to 1986. Perfect history, combined limits over $60,000, usage consistently under 3%. His grandmother added Derek as an authorized user on her 2 oldest cards. She never gave Derek a physical card or any access to the accounts. The addition was purely for strategy. Within 60 days, Derek's credit report showed accounts with 38 years of perfect payment history. His average account age went from 2 years to almost 19 years. His available credit tripled. His score jumped to 697, crossing the line that qualified him for reasonable car financing at 6% instead of 14%. On a $25,000 car loan over 5 years, that difference saved Derek nearly $5,200 in interest. His grandmother's simple action, taking maybe 10 minutes online, transferred decades of good credit instantly. Let me walk through exactly how to use this strategy the right way, because the small details really matter. First, the account you get added to has to be in good shape. Perfect payment history is what you want. Any missed payments will damage your score instead of helping. Usage should be low, best if it's under 10%. The account should be old, with older being better. The credit limit should be high compared to the balance. Second, the main account holder has to be willing to add you. This usually means family members or very close friends. They're giving you access to their positive credit history. In exchange, they're trusting that you won't misuse any card they might give you. A lot of people add authorized users without ever handing them a physical card. Third, not every card issuer reports authorized user accounts to all 3 credit bureaus. American Express, Chase, Bank of America, Capital One, and Discover usually report authorized users. Some smaller banks and credit unions don't. Check the reporting practices before you use this strategy. Fourth, the effect appears within 1 to 2 billing cycles after you get added. You don't have to wait months or years. The history transfers almost immediately once the card company reports the account to the bureaus. Fifth, you can be removed as an authorized user whenever you want, and the account will eventually disappear from your report. This makes the strategy low risk for the main account holder. If things change, they can just remove you. The math impact depends on where you're starting. Someone with a thin file and short history sees the biggest gains. Rebecca only had 2 accounts of her own, both less than 3 years old. Adding 3 accounts that averaged 14 years old completely changed her credit file's age characteristics. Someone with an established file sees smaller but still real gains. Even going from a 7-year average account age to a 12-year average can add 20 to 30 points. Now, let me answer the question you're probably thinking. Is this actually allowed? Is it legitimate? The answer is absolutely yes. The authorized user system exists on purpose within credit scoring models. FICO and VantageScore both include authorized user accounts in their calculations. The practice is clearly legal and officially recognized by credit bureaus. Why does the system work this way? Originally, the authorized user reporting existed to help married couples build credit. One spouse might handle all the money matters, opening accounts only in their name. The other spouse would have no credit history, even though they were part of a financially responsible household. Authorized user status fixed this problem by letting the credit-building spouse share their history. Over time, people figured out the system extended beyond married couples. Parents could help their kids build credit. Anyone could help anyone else, at least mechanically. The credit bureaus saw no reason to stop this because it reflects a real financial relationship. Some critics have said this is a loophole that should be closed. The credit industry has mostly ignored these complaints because changing how the authorized user system works would create other problems. For now, the strategy works completely. There are limits worth knowing about. Some mortgage lenders look closely at authorized user accounts during the approval process. They might discount or ignore those accounts when reviewing your application, even if your credit score includes them. This happens more with manual review than automated approval systems. Rebecca's lender used automated approval, which accepted her score as it was. Authorized user accounts carry less weight than main account holder accounts in some scoring formulas. FICO has adjusted its formula over the years to reduce how much accounts count where you're not the main responsible party. The effect is still significant, just not as extreme as it was 10 years ago. You stay dependent on the main account holder's behavior. If they miss a payment or max out their balance, your score gets hurt. This risk makes picking the right partner important. A family member with decades of responsible credit behavior is perfect. Let me go beyond authorized users to other things built into the credit system that most regular people don't fully take advantage of. The second technique involves understanding exactly when credit utilization gets measured and reported. Your utilization ratio, the percentage of available credit you're currently using, makes up about 30% of your score. The standard advice says keep it under 30%. More advanced advice says keep it under 10%. The actual best target is between 1 and 3%. But here's what most people don't realize. Utilization gets calculated based on the balance reported to credit bureaus, which usually happens on your statement closing date, not your payment due date. But you might pay your credit card in full every month, never pay interest, and use your cards responsibly. But if you're charging $2,000 each month on a card with a $3,000 limit, and that balance shows up on your statement, you're showing 67% utilization. Your score's getting penalized even though you pay everything off. The technique is simple. Pay down your balance before the statement closing date. not just before the due date. If you reduce your balance to $50 before the statement closes, you'll show less than 2% utilization when it gets reported to bureaus. Your score could jump 20 to 40 points almost right away just by changing when you make your payments. This timing trick takes effect within a single billing cycle. You don't need to wait months. Pay before the statement closes this month, and your updated utilization shows up on your credit report next month. The third technique involves credit limit increases and their surprisingly big impact. Utilization is a fraction. You can improve it by lowering the top number, your balances, or by raising the bottom number, your credit limits. Most people focus only on balances. The limit side of the equation often gets completely ignored. Many credit card companies offer credit limit increases with no hard check on your credit report. American Express is especially known for this. You can request an increase through their app or website, and they'll often approve big limit increases using a soft check that doesn't touch your score. Doubling your credit limit instantly cuts your utilization ratio in half. If you're carrying $2,000 on a $5,000 limit at 40% utilization, our getting that limit raised to $10,000 drops you to 20% utilization with no change in your habits. Your score improves just because the math changed. The best approach is requesting increases from all your cards every 6 to 12 months. Each increase improves your utilization ratio and available credit numbers. Over a few years, someone starting with $10,000 in total limits might build up $50,000 or more in limits just by asking regularly. Banks almost never advertise that you can request limit increases. They certainly don't encourage it. Higher limits mean customers can carry higher balances, but they also mean customers have lower utilization and better scores, which leads to those customers qualifying for better rates somewhere else. Banks prefer keeping you at limits that maintain their profits. The fourth technique involves strategic account management that most regular people get backwards. Standard advice says, closing old accounts damages your score, so never close anything. This is partly true, but often used incorrectly. What actually matters is the age of your oldest account and your average account age. Closing a fairly new account might actually help your average account age. Closing your oldest account would definitely cause damage. The strategic approach involves understanding which accounts to keep and which can be closed without harm. That store card you opened 2 years ago to get 15% off one purchase might be worth closing if it's bringing down your average account age and giving you no benefit. Meanwhile, your oldest credit card should stay open forever, even if you barely use it. Many people keep every account open because they're scared. They pile up store cards and random accounts that add confusion without benefit. A careful review of which accounts to keep and which to get rid of can actually improve your score while making your financial life simpler. The fifth technique involves something called rapid rescoring, which most regular people don't know is real. When you're in the middle of a mortgage application, time is important. Improving your score through normal methods takes 1 to 2 billing cycles for changes to show up on your report. Rapid rescoring can update your score within days. Here's how it works. Your mortgage lender can request that credit bureaus immediately update specific things on your report based on proof you give them. Pay off a credit card balance and show proof. The updated zero balance can be reflected within 72 hours instead of waiting for the next billing cycle. Rapid rescoring isn't available directly to regular people. You can only access it through a lender during an active mortgage application, but knowing it exists lets you time your credit improvements correctly. Make major improvements right before or during your mortgage process, instead of months before when the impact might fade. The rapid rescoring window creates chances for dramatic last-minute improvements. Someone who pays off a $5,000 balance mid-application can see their score updated before final approval. Someone who becomes an authorized user on a parent's account can have that account reflected within days instead of weeks. The combination of strategies used with rapid rescoring can produce score jumps of 50 to 80 points during the application process itself. Before I give you the action plan, let me talk about the mistakes that ruin these strategies most often. The first mistake is picking the wrong authorized user account. An account with high usage hurts instead of helps. An account with any missed payments in its history brings those negatives along with the positives. An account that's only 3 years old gives minimal benefit if you already have accounts that age. Check accounts carefully before getting added. The second mistake is applying for new credit while doing these strategies. Each hard check temporarily lowers your score by 5 to 10 points. Opening a new account lowers your average account age. People often destroy their improvement efforts by also opening new accounts that work against them. The third mistake is inconsistent timing on utilization management. Paying before the statement closes works only if you do it every time. 1 month of high reported utilization can erase months of careful improvement. Set calendar reminders for a few days before each statement closing date. The fourth mistake is impatience. These strategies work within 1 to 2 billing cycles, which feels slow when you're nervous about an upcoming application. People sometimes give up on the approach before giving it time to show up on their reports. Trust the timeline and check changes by polling your reports after 2 full billing cycles. Let me give you a complete action plan for using these strategies based on your current situation. If your credit score is below 650, the authorized user strategy offers the biggest potential impact. Find family members with old accounts, excellent payment history, and high limits. Ask to be added as an authorized user on 1 to 3 accounts. At the same time, deal with any negative items on your report through proper dispute channels for items that are wrong. Pay down any credit card balances to below 10% of limits before your next statement closes. If your score is between 650 and 720, you're in the improvement zone where multiple small changes can create big gains. Request credit limit increases on all existing cards. Adjust payment timing to reduce reported utilization. Think about the authorized user strategy if you have thin file problems or short account history. Look for any old negative items that might qualify for goodwill removal if you have a history of good behavior with that lender since then. If your score is above 720, you're likely fine for most things, but improvement still matters for the best mortgage rates. The difference between 750 and 780 might seem small, but turns into meaningfully different interest rate offers. Focus on utilization timing, limit increases, and keeping the positive patterns you've already built. No matter where you're starting, everyone should pull their free credit reports from all 3 bureaus once a year and look them over for mistakes. Studies consistently show that a meaningful percentage of credit reports have errors, some big enough to affect scores and loan eligibility. Disputing real errors is completely separate from the strategies I've described and should happen alongside them. There's a deeper truth underneath all these tactics that changes how you should think about credit scores completely. The credit scoring system was designed by lenders to predict risk for lenders. It wasn't designed to help you improve your financial life. It was designed to help banks decide how much to charge you. The system shows certain information and hides other information in ways that serve institutional interests over your interests. Banks don't explain the authorized user strategy because it helps you escape their high-interest products faster. Credit bureaus don't advertise utilization timing because confusion keeps regular people dependent on credit monitoring services. The whole industry benefits from people believing credit improvement is a slow, mysterious process requiring patience and maybe paid help. The reality is that credit scoring follows mechanical rules. Those rules can be known. Once known, they can be improved. The gap between people who understand the rules and people who don't turns directly into wealth differences over time. Someone who keeps a 780 score instead of a 680 score will pay dramatically less interest across their lifetime. Lower mortgage rates, lower car loan rates, better credit card deals, reduced insurance costs. The savings build up over decades. These strategies work because you're operating within the system's actual rules instead of the simplified stories told about those rules. You're not cheating. You're not exploiting errors. You're simply using features that exist by design but aren't advertised by institutions that profit from your ignorance. Rebecca's 140-point jump in 93 days changed her financial path permanently. The $215,000 she'll save on mortgage interest will fund her retirement. The knowledge she gained applies to every credit decision she'll make for the rest of her life. That same knowledge is now available to you. The technique isn't hidden because it's illegal or wrong. It's hidden because nobody with a profit motive benefits from you knowing it. Now you know. What you do with that information is up to you.